Hello, let's talk about recording sales and sales tax for a merchandising business. In previous videos, we focused on service businesses. Starting with this video, we'll focus on merchandising businesses which sell goods that they purchase for resale. Merchandising businesses require a different chart of accounts than a service business because a merchandising business sells products, not services. And our accounting practices will be different as well. To learn about the accounting practices of merchandising businesses, we will focus on Max Out Sporting Goods. This business sells the latest sporting goods and sportswear for men, women, and children. It's a retail business, and Max Ferrero is the sole proprietor of the firm. A retail business requires an accounting system to account for merchandise inventory that is purchased, that has been sold, and that is on hand at any time during the accounting cycle. Max Out Sporting Goods buys products from its suppliers and posts its available for sale inventory in an account called merchandise inventory. We will also be studying the periodic inventory system. The cost of inventory on hand must be determined by counting merchandise inventory in stock. That is why it's called periodic inventory, because the business periodically counts what it has in inventory. The inventory could be done yearly, quarterly, monthly, weekly, or another frequency. That is one of the disadvantages of the periodic inventory system. You need to count your inventory to know how many items you have in stock. For the perpetual inventory system, on the other hand, the business keeps track of the inventory with every purchase or sale and knows how much it should have in its inventory based on those records. Such a system is more expensive because you need specific systems and processes. And that is why larger businesses typically use it. These businesses still have to count their inventory, but typically only do what is called a cycle count, meaning you're just double checking the accuracy of your system and you're checking for loss and fraud. Cycle counts count a certain percentage of products each period. For instance, you count 9% of the products in January and 9% of other products in February and 9% in March and so on, so that you effectively cycle count through your entire inventory during the year. What else is different for a merchandising business compared to a service business? Well, the sales account is the revenue account used by merchandising businesses or retailers to record sales of merchandise. We will not be using fees income as we did in our prior examples for Eli's Consulting. We'll now be able to look at how sales for a merchandising business are recorded when the customers buy merchandise for cash or on credit. There are 5 new accounts that we'll be using to record merchandising sales transactions. There are sales, sales tax payable, sales discounts, sales returns and allowances, and credit card expense. The sales account is the primary revenue account for a merchandising company. Merchandising businesses also have to collect sales tax for the state tax agency, and the business records that amount as a liability. The merchandising business also uses the sales discount and sales returns and allowances accounts, which are contra revenue accounts. We'll also be using the credit card expense account when the merchandising business processes credit card payments from customers and is charged a fee by the credit card processing company. So let's practice these new transactions together. In our first transaction, Max Out Sporting Goods sells merchandise for cash. We record the sale of $500 for cash by first writing the date into the date column, and then cash into the description column, and $500 into the debit column. We debit cash because the business's cash increased, and cash increases with the debit. On the next line, we slightly indent and write sales into the description column, $500 into the credit column. We credit the sales account because sales increased, and sales is an account that increases with credits. So let's look at the next transaction. Max Out Sporting Goods also grants credit terms to certain customers. On January 3rd, Max Out Sporting Goods sold merchandise on credit to Roy Anderson, issuing sales slip 1101 for $400. We record this transaction by first writing the date into the date columns, and then accounts receivable into the description column, and $400 into the debit column. On the next line, we slightly indent and write sales into the description column and $400 into the credit column. When Roy Anderson placed Max Out Sporting Goods on January 31st, we reduced the accounts receivable account and increased cash by first writing the date into the date columns, cash into the description column, and then $400 into the debit column. On the next line, we slightly indent and write accounts receivable into the description column and $400 into the credit column. Most state and many local governments impose a sales tax on the sale of certain goods and services. Businesses are required to collect this tax from their customers and pay it to the tax agencies. There are special rules around what is called sales tax nexus, the requirement of a business to collect sales tax in a state. Some sales are exempt, whereas in other cases, the purchaser has a sales tax exempt certificate. In other cases, sales across state lines are only taxable if they exceed a certain dollar amount. In general, though, when taxable goods and services are sold on cash or credit, the sales tax is recorded at the time of sale, even though it will be collected from the customer later in the case of a credit sale. A liability account called sales tax payable is credited for the sales tax charged. So let's look at this transaction where Max Out Sporting Goods was required to charge its customers an 8% sales tax. The amount collected for the sales tax on a $500 sale for cash would be $40, which is calculated by multiplying 500 times 8%. We record this cash sale by debiting cash for $540. Why $540? Because the customer paid Max Out the sales tax, which the business in turn must pay to the tax agency. That liability for the sales tax is recorded on the second line by slightly indenting and writing sales tax payable into the description column and $40 into the credit column. The sale amount is recorded on the third line by, again, slightly indenting and writing sales into the description column and $500 into the credit column. This next transaction is very similar, but instead of collecting the cash immediately from the customer, in this case, the customer purchased merchandise on credit for $600 plus sales tax. We record this credit sale by debiting accounts receivable for $648. And why $648? Because the customer owes Max Out the sales tax, which the business in turn must pay to the tax agency. That liability for the sales tax is recorded on the second line by slightly indenting and writing sales tax payable in the description column and $48 into the credit column. The sale amount is recorded on the third line, and we again slightly indent and write sales into the description column and $600 into the credit column. We previously talked about the audit trail and proper documentation for all accounting transactions. Such documentation is also required for sales transactions. The sales slip tells us who the customer is and the sales amount, the sales tax charged, and the total amount that the customer must pay. Often these sales slips are digital documents rather than printed sales slips.